it's a pretty shabby outcome if at the end of your working life you get a fistful of dollars, but you live in a community that is degraded and an environment that is so polluted that your quality of life has been lost. And that is not just a matter for politicians, it's also for those who control the levers of the economy, and they are, to a large extent, those people who manage superannuation funds, which can be invested for good or for ill.
Super funds have an overarching responsibility to generate good returns for their members, and I think producing good returns is entirely consistent with taking into account both financial and non-financial factors in investment decisions. So I think the debate we're having around environmental and social governance is very positive, because I think it is really forcing finance professionals to round out their analysis, look beyond the square, look beyond the the narrow confines of what the financials might be for a company.
I'm a person who lives in community. I'm only defined by virtue of the relationship to others. That's actually what true identity, individual identity is in relationship. So I want, in my super policy, there to be socially sustainable, community-based programs to ensure that my community continues. I think what that means is that when I invest, I should be asking the ethical questions, the environmental questions, the social sustainability questions, and comparing super funds and making a choice with those factors factored in.
I think it's important to us to look at areas like human resources. How do companies employ people? How do they treat the people who work for them? How do they view the community in which they operate, and what do they give back to the community? I think these are very important things for us to look at when we're considering investment options.
A company that treats its staff poorly and has a very high staff turnover, that's got to have a material effect on the bottom line. But I don't believe that that's, in your standard balance sheet analysis that's done today, that's not incorporated. So I think a challenge is to start rewarding companies that do have enlightened policies around social capital and hence would have lower staff turnover.
Traditionally, risk didn't always comprehend those factors of governance and management of human capital, but I think, and societal good, but I think increasingly that's part of what you have to examine in the risk context.
If a company is not doing the right things and not conducting its affairs such that it is sustainable, it may not be around for the next 5 or 10 years.
People are going to think much more about other issues beyond returns. CMSF really did start the discussion about corporate governance, and after AXI came into being, we've seen a lot more interest and engagement about good corporate behaviour. But I have to say that it's not got very far in respect of some companies.
I think a company that looks after its staff well is kind of setting itself up to look after its customers well as well.
All companies are a marriage of capital and people, and both sides are important.
I think the way an organisation treats its people is actually central to the success of the organisation.
The wise manager these days is taking account of these sort of issues, because they're building in, concerns about social issues, the environment. They build in big risks associated with individual companies depending on the nature of their process.
We think there's going to be pressure coming through over the next couple of decades to say, yes, you're a superannuation fund, but what actually are you doing for society and for the environment? And if I can't tick off those two boxes, then you've got a problem.
It's good to see that most people in this industry recognise that superannuation is organic and needs to grow and change to meet members and community needs. Over the years, we've seen the emergence of a number of different elements that impact on our mission to ensure that we not only maximise returns for members' retirements, but also help raise standards. Elements such as corporate governance, social responsible investments, and our scrutiny of corporate and institutional behaviour have moved quickly from novelty to mainstream. This scrutiny is resulting in improved behaviour and better management.
Good morning. Welcome to Blind Spots in Company Valuation, Understanding Social Capital. My name is Colin Tate. I'm an Executive Director at Conexus Financial, and we're proud to be the official magazine of CMSF with investment and technology, and also the publisher of the daily news here at CMSF. I'd like to, before we move on, thank Andrew Dawson and his team from FTV. They're responsible for all the video montages you're experiencing, like the one just now. Right throughout CMSF, there has been hundreds of interviews all over the country. Can we show our appreciation to Andrew Dawson, please, and FTV Television? There also appears to be a little confusion in relation to the changed plenaries of this afternoon. Please note that the Ratings Agency's plenary session is today at 3:50 p.m. due to a change in the Minister's schedule. Nick Sherry will now appear tomorrow morning at 8:45 a.m. The reason for the confusion is your conference program in your book is correct. The pocket program in your name tag is incorrect. We'll run a test on this at the end of the session. Just remember, this afternoon is the Ratings Agency's 3:50. Tomorrow morning is Nick Sherry at 8:45 a.m. Given that you're all coming to all sessions, I'm sure that probably doesn't really matter anyway. Ladies and gentlemen, please welcome Michael Anderson. Michael has more than 20 years' experience in the investment world. He has an extensive background in Australian equities management at AMP Capital Investors and has held a number of senior positions there. In 1989, Michael became head of the Australian Industrial Share Research Team. 1989, and then in 1991 he was appointed portfolio manager. Since then, Michael has had a significant role in developing the business models and investment processes of many of the Australian equity businesses at AMP Capital, including the Enhanced Index, Active Quant, Protected Growth, Value Plus and Sustainable teams. Michael has also led Australian Equities, and as Director of Advanced Strategies, Michael is responsible for assisting the business incubate new investment and hedge fund capabilities. Since 2000, Michael's key focus has been leading the Sustainable Alpha Funds team with the goals of providing superior returns and meeting client values. With his team, Michael has been responsible for developing the Sustainable Alpha process, which focuses on improving the traditional company valuations through analysing more of the intangible dimensions of a company's performance. Please welcome Michael Anderson.
Well, almost good afternoon, everyone. I came up this morning from Sydney, and I heard on New South Wales Talkback Radio that the head of Unions New South Wales wanted people to be paid for working while commuting to and from work. So that included people who were dictating into phones beside them and all that sort of stuff. Now, it gave me cause to reflect that there are probably two sorts of people in this audience here today. There's probably those who think that has legs, that's a good idea. And there's probably those who think that work choices was actually too easy on all the workers. Now, you may be the sort of person who runs around your shower in order to get wet because you're using one of those water-saving shower heads, or you may in fact be one of the people who goes out with a torch at midnight to wash your car with as much water as you like and make sure that you don't get reported for it. Now, my point about that is these are good topics, but they're actually not what I'm going to be talking about, because what I want to talk about is to the people in the audience who are investors and are interested in where to find our performance and how that can be found, in fact, through understanding social capital. So my topic today, as you can see, is blind spots in company valuation, understanding social capital. And the way we're going to run through it is to give a quick overview of where some of those places might be where you can find some value. Firstly, are there blind spots generally in company valuation? Secondly, are there more particularly places where you can look for value in social capital? And lastly, I want to bring it together to look at what that overall opportunity looks like. Let me begin. Here's an interesting stat, which I think guides a lot of my thinking, and that is 3/4 of Australian share market company valuation is made up of intangibles, things you can't touch. It's things, and you can think of medical companies like Cochlear and ResMed and so on. It's things like the quality of the goods they produce. It's things like their research and development. It's things like the whole intellectual property piece. When it gets down to it, It's actually having the right people in the organisation, keeping them there, and also having the right systems. Because if those companies have quality problems, they really have big problems with their market cap falling substantially. So what you begin to get to when you begin to think about that number is that things have changed a lot. 20 years ago, that number was more like 25%. Yet the question I raise is, has our analysis of investments changed to keep pace? Because I would suggest that we are still tending to focus on the tangible piece. We're focusing on, operational capability, the Porter principles and so on, all good stuff. But we're not spending enough time on the part below the line. Things like human capital management, culture, leadership, things like the risk management of the supply chain, and I could go on. But I want to think more generally about environmental, social and governance issues. They are all ongoing and continuing to grow over the last decade, and you can see that their influence has become more and more important. But I think each of them has also gone through a bit of a tipping point. If you think about the governance side, you could easily say that governance or poor governance had been a problem for quite a while, but when we got to 2002, it became a much bigger problem around the world with Enron and HIH and so on. And there's significant reactions. You saw ASX governance rules, you saw AXI do some significant work, IFSA upgrade its work as well in Australia. And there's a lot happening around the world, of course. You've seen tipping points on environmental issues too. If you think particularly about climate change, that was an ongoing issue and had been increasing in importance around the world. But the IPCC reports, the scientists' reports, plus Al Gore's work in terms of his movie, had a significant effect and tipped them over in terms of how important they became to the economy and to voters. And the reaction was governments quickly decided they needed greener credentials than they had before, as did oppositions. And you're now going to see carbon trading in Australia, not just in Europe where it had already been going on. You can see where I'm getting to. I'm going to also suggest that the same thing is beginning to occur on the social side. The big issue is that companies nowadays are relying more and more on their staff as part of this big intangible piece as it's been growing. And part of this tipping point, I would suggest, is the fact that we now have significant staff shortages. We have the new changing mindset, particularly coming through Gen Y, but really through all generations, about what is important in the place that I work, what I want to get from the place that I work. And that is leading to reaction. The sort of reaction it's leading to is the war for talent. And you've already begun to see that happening, but I'm suggesting that it's probably going to go up another leg. And you've seen the need to ensure, as a company, that you've got a licence to operate. And I'll expand on that with this. Here's a stat. Most consumers believe corporate obligations to shareholders must be balanced by contributions to the public good. Okay, so that's interesting. What does it mean? Well, who was surveyed? First, it was about 4,000 plus executives from around the world by McKinsey, and then about 4,000 consumers as well from around the world. What did it mean? Well, the meaning that they gave it was public good meant going beyond legal requirements to provide good jobs, philanthropic donations, minimising pollution and other negative effects of business. Now, it's an interesting stat, isn't it? In a sort of, particularly in an economic rationalist world, that the vast proportion of consumers, at least, think this is what companies should be doing. Why does it matter? Isn't that just their opinion? Well, the thing is, and the mechanism which makes this important is these people vote and these people are consumers. And governments angle to get their vote, and in the end, if you're a company that doesn't worry about your consumers, you run into problems. And you saw James Hardie doing what it thought was the legal minimum and finding out that its customers and others around it didn't think that was sufficient. That was around the asbestos liabilities. So, I've very briefly just touched on a few things, and my point was to show you straight up that social capital has the potential to be quite important. And it may even be at a bit of a tipping point in terms of its importance. But my next question is, how do you make money from understanding it better? Let me suggest there are 3 places you could dig. I'm going to go through each of them briefly. The talent pool mutual care and great expectations. First area, the talent pool. So let's just take a step and think about superior management. What is superior management of a company? Is it being good at acquiring things? Is it good at, counting the beans, sort of cost efficiency and so on? What are the things which make a really great company, and particularly really superior management? Well, as preparation for today, we actually did a study specifically around that point. What are superior management qualities? We asked top 100 companies, and we asked some of the top brokers in the marketplace what they thought were the superior characteristics of superior management. Sorry, the characteristics of superior management. So the question was, superior management teams allocate their time resources as follows, and they're asked to give a rank to those 7 items. Now you might want to have a quick think about that. If many of you are CEOs or trustees or Chief Investment Officers or whatever within your organisations. What do you think in your organisations are the things that really make the difference to the long-term value of your organisation? Now, I don't have time to get you to answer that, but I'm going to give you what the answers were for, firstly, the investment professionals. So we're talking about top brokers here. That was what they thought was the right order. So you can immediately see, if you're head of IT, you're feeling pretty depressed around about now. In fact, if you're in R&D or product development, you're also, not feeling too excited. Head of HR is feeling sort of okay. Acquisitions and divestments thought he was a lot more important than that because he gets taken out to very expensive restaurants. Head of marketing and sales feeling sort of okay. And head of strategy is feeling pretty pumped. And the CFO is asking for an increase in his LTI, long-term incentive. So what about the listed company executives from the top 100 companies, excluding REITs? What did they come up with? This was their list. And if you had a chance to compare it side by side with the previous list, you'd find out there was 2 main changes, which are these. People and culture went from 5 to 1, and cost management and efficiency went from 1 to 4. The rest of them stayed pretty much stable. So what you're seeing is a very different opinion about what matters most. Now, of course, if you're head of HR, you've now asked for your own long-term incentive. And if you're the CFO, you're really quite depressed and you've written off a few bad debts in a fit of pique just to make you feel better. But the bottom line, of course, is it's not quite as simple as that. If you're a company which is really serious about culture and people, it's not just down to the head of HR. It's actually down to the CEO, it's down to all the senior management. In fact, it's really get down to the whole company. But I guess the CEO and the senior management really set the tone, and if they do it for long enough, that actually has an impact on the whole company. Now, the real interesting question off this is, we've got one answer from, I guess, the market wisdom caught up in the brokers, and another answer from the companies themselves. And the real question is, who's actually right? And at this stage, you may have an opinion, but unless you've done research around that, it's not actually clear. Let me show you some research that was done last year. It was done looking at the best employer companies from the Fortune magazine's best companies to work for in America. And what it showed was that those that were rated better did well 7 out of 8 years. The definitions are quite interesting, but we'll skip that at the moment, because what I want to show you is, okay, so that looks fairly strong in terms of evidence. Is there anything more? Well, if that seems a coincidence, it's interesting to look at this. The first 2 points are actually the same points. Over the whole period, the better employer portfolio actually outperformed by about 8%, the blue versus the grey. But if you looked at those that had just fallen off the perch and had been rated best employers but were no longer, they actually still outperformed because they were above average, but they didn't outperform by as much. And that's the sort of result you would expect, given our hypothesis that maybe culture and people are actually really important. So let's say we now believe that, and that you need to do a whole lot more research to really back it up, but I suggest that the evidence does support that. How easy is it to identify the best employers as an investor? I'd suggest there are 3 steps. Firstly, you actually need to identify the metrics that matter. And each blue dot here is one of 30 metrics that, for example, we could look at to identify who are better employers. Things like low voluntary turnover, or have they got significant training related to the career, and so on. But the second and third things you need to think about are the 2 scales I've put up there. So when we think about it, we think, is this one actually have a demonstrable link with shareholder return? Or is it just a good idea which doesn't seem to flow through for one reason or another? And secondly, the vertical scale, can you actually measure it from outside the organisation? Because as an investor, we're normally sitting outside the organisation. So if you have the right expertise, can you measure it? And where you get to is ultimately you want to look for those metrics that are in quadrant 2, that have strong links with investment performance and are also more measurable from outside the organisation. And some examples of that are training related to career and the opportunity for a 360-degree feedback of managers within the organisation. But there's a whole lot of other ones you can see that fit into the different spots. I'll just give you briefly an example of a company that we think has done pretty well in this area. They've put through a whole lot of programs, as some just mentioned, looked at, you can see down the bottom of the page, there's actually a whole lot more, we don't have time to go through them, but over a sustained period from about 2000 to 2001, they've done a lot in terms of trying to be one of the best employers. The net result is that at the end of that period, their staff, when they actually rank the organisation about what seems to be important to the organisation, they used to rank cost efficiency as number 1, as what we see as staff seems to be important to the organisation. Nowadays, they actually rank customer focus and a few other things as number 1. So that's just an internal measure of what they think the management think is important. And you've seen big increases in staff satisfaction, big increases in customer satisfaction to the point that they're pretty much the leader in both those 2. And if you look across the major, so we would rate ANZ as one of the leaders in terms of this particular social capital area. And when we look at the top banks against the worst banks on those human capital ratings, we find also that the better companies have outperformed. Let me move to the second blind spot, mutual care. If you think about the cost of workplace health and safety, it's quite instructive to look at the numbers. The total cost of work-related injury and illness in the construction industry actually equals earnings. At least it did in 2005, which is a massive number when you think about it. Now, that, of course, in an industry where this is really important and which has really, I guess, poor performance. A whole lot of other stats you can look at. We're talking about $8 billion a year that flows out of companies' profits and loss statements. And you can see that corporate company executives actually think it's increasingly important. But let's see what sort of financial spoils go to a company that gets it right. Here's Qantas's BeSafe program. It started, I think, in fact, before 2004, but got really pulled together in 2004. And you can see big reductions in lost time, big reductions in workers' comp, big return on investment, and the big number down the bottom of about 500 million predicted savings over 5 years shows that there are pretty significant returns that can be made to this sort of program. Now, the immediate question, and I asked of the expert in my team, how did they manage to do that? When it came down to it, they actually did the obvious things, but they really meant it. They did things like put in place policies, put in place training, put in place monitoring, communicating results to the people, through the organisation at a more local level, and making sure senior executives reported on it and were responsible for it. Classic things you'd expect, but they did it seriously and they meant it, as opposed to it just being an edict from head office, we care about safety, don't we? Which we sometimes see. So when you look at, I mentioned construction industry, it's instructive to see how important that seems to be. Because when you look at the better companies in the construction industry, the cumulative average growth rate of their company share price well exceeds those of the poorer companies. Why is that the case? Well, I don't want to spend much time on this because I think you already know. There are obviously lots of feedback loops between OH&S and the financial performance of companies. And I guess the reason why I've called this section mutual care is simply because in a time where there are key labour shortages, and particularly in high-risk industries, staff have choices and they actually care about being cared about, and they're more likely to look after their employer when it comes to various job offers coming through. And so in this world where the war on talent is becoming more and more urgent, it's actually something you can do to make sure your human capital gets the right sort of returns. Again, when we look at the treasure map, lots of things you can look at, and it's important to work out what things make a difference. It obviously varies by sector, and you sometimes find companies down the bottom. BP was a company where with their Texas City refinery, they actually cut costs. They had kept their OH&S policies and their head office intact, but what they didn't realise was they'd cut out a lot of the OH&S stuff on the ground at the operational level. As a consequence, a lot of deaths, and as a consequence, major fines down the track. And that's an example where the company thought it was still on top of things, but if you scratched beneath the surface, you would have found that head office was on top of things, but the rest of the business was not. Give you an example of the Australian company briefly. The fourth highest percentage increase in fatalities in an ASX 100 company over 3 years is Downer EDI. That's not good, surprised to say. But they have made some progress. 3 things there. Their lost time injury frequency rates halved, but having said that, it hasn't actually continued to fall in the last 3 years. But importantly, the board's taken some responsibility, senior management has changed and taken some responsibility as well. So we're seeing, I guess, a lift in a company like that. But in the construction industry, it's actually at the core of what they do, and they need to be good at it to get good financial returns.